Welcome back to the Citi India Conference. I have one person whom we track very closely, or whose writings we track very closely, Markus Rosgen. He's the head of GEMs strategy, that is the emerging market strategy for Citi. Markus, it's a pleasure speaking to you face to face. We've always spoken long distance. Well, first up, when we look at the flows picture, India has been more, driven by domestic flows rather than by global flows. How does that change your place of India in your emerging market basket?
Well, good to see you again, as I said, face to face. I mean, it's been interesting. The flows in India have been, as you said, very domestic. But even if you look at it from a global perspective, India has been well endowed as far as global flows are also concerned. So if you looked at the size of the Indian market relative to the other markets in Asia or in EM, people have put more than 4 times more money into India than the relative weight of India. So you've had a very strong dynamic, which has been both the local flows, post kind of demonetization, people thought, what shall I do, where shall I put my money, and it's gone into the equity market. And then from a global perspective, the investors are still a little bit concerned about the global cycle. Do we have a synchronized global recovery? How long will this recovery last? And so India is always viewed as a more defensive market, as opposed to, let's say, a China or a Korea or a Taiwan amongst the larger markets, or even further afield. If you're not so sure about the global cycle, you're probably not going to be very optimistic on the outlook for the commodity-heavy markets of Brazil or Russia. So where you've had this kind of weird environment is that global flows have come back to emerging markets. But even today, if we look at where we are, we're only really back to where we were in late 15 in terms of flows. So money went out, it's kind of come back, we're back to the same level. But what has put India apart is that it has been particularly strongly influenced by the local flows. And so it really stands out on that front. Other markets have been more influenced again by the global, but India has been very much local. And the icing on the cake has been that global investors have also liked the market on top of that.
Okay, if you can give us some idea of how the flows are panning out in, say, the last 2 months. We have seen the dollar weaken, actually. The dollar index had gone all the way to 105 in the Trump trade, and then it receded rather sharply to 97. So does it mean that money is getting pulled out of US equities, global flows? Are emerging markets the beneficiary? What are the key trends of global flows in the last 2 months?
Well, the key flows have been really in the US has been, first and foremost, after the Trump election, a lot of the money went into the US. Money actually went out of emerging markets because people were worried about protectionism, border adjustment tax. That's what led the dollar to rally. It then became obvious that border protection isn't going to happen, border tax isn't going to happen, and so the dollar began to weaken. And I think people also realized that the Trump policies were very much kind of fiscally negative, by spending more money and not necessarily fiscally neutral. So a weaker dollar helps all emerging markets. It's always good for us when the dollar is weak because our own currencies tend to appreciate, and therefore there's less pressure on interest rates. So from that perspective, things have panned out very nicely for us in the EM. So risk appetite has come back. Now, the money that kind of went into the US, there has been some flow back into EM. And as I said, we've kind of gone from the lows. Our total AUM that's come in is back to where it was in 2015. But we're still 70–80% below where we were at the peak post the global financial crisis. So we've had a little bit of money come in, but what's interesting is in, I'd say, 7 out of 10 of the meetings that I have with our clients, people still always like to talk about downside risk. What if China goes wrong? What if there's a skirmish in Korea, in the Korean peninsula? What if the European economy falters? What if Donald Trump doesn't manage to put anything through in terms of his agenda? So we still have an investor base that is generally quite bearish. And that's true within Asia or EM, but it's also true of the global CIOs. They're not all overweight our asset class. So from a flow perspective, if you're looking forward, what's interesting is that you can see that EM outperformed versus DM last year. It's outperforming again this year relative to developed markets. And if you don't own it, you underperform. And the one thing that changes fund managers' minds more rapidly than anything else is underperformance. So the outlook for flows going forward is very strong. Where, though, there would be something of a bit of a change is that given that India has been the majority recipient thus far, I would have thought that going forward there'll be a little bit of a change in the mix, that you're not going to keep putting more and more money in India, increasing your overweight at the detriment of everybody else.
Actually, that was going to be my next question. You know, if you have to crystal ball gaze, how would you look at flows over the next quarter or for the remaining part of 2017? First for EMs and India in EM.
Well, the interesting thing is we can download about $400 billion worth of AUM. These are fund managers that have to report every month, you know, what they own. And when you do that, the number one overweight in EM funds is India. And it's an overweight by a long shot. We're talking 400 or 500 basis points over the index. If you go to the other end of the distribution, what you find is that the big underweights are China, Korea, and Taiwan. I mean, those are the markets that people generally are still a little bit skittish of, because obviously if the global growth cycle isn't very strong, you're going to worry about cyclical markets like Korea or Taiwan. Most questions in most meetings tend to always revolve around China. You know, is China going to slow down in the second half of the year? What's the policy mix? So people are a little bit coy there. So if I look forward, and I look at basically what people own, most of these 400 billion of AUM are still quite conservatively positioned. So they like consumer staples, they like some consumer discretionary, they like the healthcare pharma space. But they're underweight technology, they're underweight materials, they're underweight cyclicals, which is again something that you see within India itself, right? People really like the banks in India, but they're not so keen on the more cyclical part of the market. So the rotation I can see in terms of fund flows is towards a more cyclical bias. But that would also lead people maybe, rather than putting more money into India, that for a while, at least from a foreign fund flow, India doesn't necessarily get outflows, it just doesn't get more inflows as people start to say, okay, well look, if the global growth environment is indeed improving, which is a Citi House view, then I ought to put a little bit more into China, I ought to have a little bit more in Korea and Taiwan, because clearly they've been beneficiaries or are going to be beneficiaries of this growth pickup. So more money towards the cyclicals. And within that, India will be a little bit of a laggard in terms of external flows. Now, a lot of it will then depend, you know, whether you're going to see lower rates here, which, you know, clearly the inflation print was weaker, so there is maybe room for rates to come lower here, which would entice local investors to kind of sit down and say, okay, well, I can leave my money in the bank, or I can buy equities, and normally as rates go down, people tend to move out the risk curve a little bit.
Well, that's the key takeaway from Markus Rosgen, that incremental dollar flows may come to the emerging markets, but may not come to India, since the fund managers are already probably 400, 500 basis points above the benchmark in terms of their weighting of India. But within India itself, there could be a churn from the HDFCs and the HULs and the ITCs to cyclicals, like probably the Larsens and the autos.